Assalamualaikum listeners. Welcome back. Today I'm here to discuss the exercises of chapter number 10, which is plant assets, natural resources, and intangible assets. If you have not listened to the recording of chapter number 10 regarding the discussion of details of chapter, then please listen to my previous recordings which are already being uploaded, because without understanding the theoretical concepts, it will be difficult for you to understand these examples. I have selected few exercises for you and I'm going to solve them with you so that we can just review all the concepts which we have taken in chapter number 10. So starting with the first exercise of chapter number 10, which is exercise number, this is 10-1. So let's read it and try to solve it together. The following expenditures relating to the plant assets were made by Prather Company during the first 2 months of 2017. So some expenditures are listed over here regarding the plant assets. Let's read the instructions first and then we will move on. So instruction says that explain the application of historical cost principle in determining the acquisition cost of the plant assets. Means what is historical cost principle and what is it saying regarding the plant assets. So it's a theoretical thing. You need to write the same definition which we have taken in the chapter, that what does historical cost means regarding the plant assets. In part number B, they want us to list the number of foregoing transactions. So what is the number? Can you see over here? We have basically 8 numbers starting from 1 till 8. So they want us to list the number of these transactions, and opposite to each indicate the account title to which the expenditure should be debited. So we will be reading one by one each of these statements, and we will be saying that either we should debit it to land, to building, to it's non-plant assets. Which type of asset is this? Is it an expense? So we need to identify each and everything. So starting with part 1, it's a theoretical discussion. So here I wrote the answer for you, that historical cost principle says that we have to add up all the expenditures which we incur in order to make the asset ready for its intended use. Like we always say that whenever you purchase a plant asset, according to the historical cost principle, all the expenditures should be added up to calculate the cost of the asset until and unless the asset is ready for use. So here's one of the common example which we usually use, that is the factory machinery, or you can say machinery, or you can say equipment. If you want to calculate the cost of the factory machinery, you have to add all these costs. So what are the costs? Of course, it's purchase price. Then you need to bring this machinery to your location. So the freight charges or the freight cost which you will be paying, if you are paying, your purchaser. So if you will pay, then add it. If a seller will pay, then no need to add. But here we will be adding because paid by purchaser. And then insurance in transit cost. I'm not talking about annual insurance, because annual insurance is renewable. That's not a cost for the plant asset. That is either prepaid or either that's insurance expense. So only insurance in transit is added to the cost of plant asset. And then the installation cost. I'll also mention the testing cost. If you test the first batch of the product just for the testing purpose, that cost will also be included. So this is what historical cost principle says regarding the plant assets. Let's talk about part number B. Point B says that list all these numbers of transaction and mention that which account should be debited. What I did, I just copied these transactions for you so that it's easy. We don't need to scroll up again and again. So if you see here, I wrote the number, and then against those number, I have written all these transactions, and let's try to identify. For time being, don't look at the answer. Let's try to understand what is the statement, and then accordingly you will be figuring out. So number 1 says that paid $500 of accrued taxes. Accrued means payable, right? Accrued taxes at the time plant site was acquired. You purchased a site, an area for your plant. It's just a site right now. You acquired it, and at that time you paid the accrued taxes on it. So payable taxes. we will not be able to use this plant site until and unless we pay all these taxes. So that's why these taxes cost which are accrued, that will be added to the cost of the land. So that's why we will be debiting the land account. Second point, paid $200 insurance to cover possible accident losses on new factory machinery. Okay, till here they are saying we are paying insurance. Let's figure out, is it annual insurance or is it insurance in transit? Because only insurance in transit is added to the cost of equipment. So see here, while the machinery was in transit, means you purchase it and machinery is coming to your location through a transportation. So at that time you did the insurance. That's why we will debit it to equipment account. Paid $800 sales taxes on new delivery truck. So you purchased a delivery truck and you paid 800 sales taxes on it. So delivery truck is also a form of equipment. Paid $17,500 for parking lots and driveways on the new plant site. Plant site, you have incur some cost to make these driveways and parking lots. These driveways and parking lots has limited life, and we already talked about them, that they are considered as land improvement. That's another type of plant asset. Moving on towards point number 5, paid $250 to have company name and advertising slogan painted on the new delivery truck. So this is painting cost on the new truck. So it will be added because without painting this, after that you will be using this truck. So that's why it will be debited to equipment. Paid $8,000 for the installation of the new factory machinery. So installation cost is added to equipment because without installing we cannot use the equipment. Paid $900 for 1 year accident insurance policy. Can you see? 1 year means every year you have to renew it. So it's annual insurance policy. We don't add it to the cost of equipment. It is a prepaid insurance because you have incurred this cost for 1 full year. And when the year will come to an end, then you will, for the next year, you will again purchase this insurance. So it's prepaid insurance, and prepaid insurance, it's a current asset, right? Okay. Paid $75 motor vehicle license fee. Motor vehicle license fee, every time you have to renew the license on the new truck, so it's a license expense. So this is the explanation for your exercise number 10-1. Now, on the similar ground, we are also going to solve exercise number 10-2. 10-2 says that Benedict Company incurred the following cost. So I have added all the cost again in the tabular form. There are 9 transactions, and indicate to which account Benedict would debit each of the following cost. So the only difference in question number 1 and question number 2 is that in question number 1 amounts were written with the statements, and in question number 2 they are separate in dollars. So the same way, read, identify and debit. So number 1 is sales taxes on the factory machinery purchase. We just talked about it above, so that's equipment. Painting of and lettering on the truck immediately upon purchase. Just now we took it, so that's also equipment. Installation and testing of the factory machinery. Just few minutes back we took it. It's also equipment. Real estate broker's commission. Now real estate broker commission could be on the purchase of building, on the purchase of land. So let's figure out for what you have paid this real estate broker commission. So can you see? On land purchase. So I'll be debiting it to the land account. Insurance premium paid for the first year insurance on new truck. So again, it's prepaid insurance. Cost of landscaping. Landscaping is just like parking lots and driveways. So landscaping and some greenery, you do it on the property. So you did some landscaping, that is land improvement. Cost of paving parking lots for new building constructed. So that's also land improvement. Cost of clearing, draining and filling the land. This is you have to do before using the land. You have to clean the bushes on the land, or if some garbage or some rubbish stuff is there, you have to remove that. The draining things you have to clean, and also you have to fill the land if the land level is down. So you have to fill it with mud so that you can use it. So all these things are preparation of the land. And then architect fee on self-constructed building. We took it in the chapter that when you are constructing the building by yourself, then the architect fee will be debited to the building account. Let's move on towards question number 3. Let's read the statement, try to identify what we are supposed to do, and then we will be recording it. So on March 1st, 2017, Westmoreland Company acquired real estate on which it planned to construct a small office building. So they purchased a real estate because they want to construct office building on it. The company paid $75,000 in cash. So this is the amount they paid. An old warehouse on the property was razed. Razed means you removed an old warehouse, because in the presence of that warehouse, you cannot construct the office building. So an old warehouse on the property was raised at a cost of $8,600. You have paid this money to the company for breaking down that old warehouse on your land. And then what happened? You sell the scrap, the broken parts of the warehouse. So the salvaged material, the scrap, you sold it and you get the money, $1,700. So actually you have given $8,600 to the company that please remove this warehouse, and then you sell that scrap for $1,700. So you get some money back. So net value, which is $6,900, is the cost which you have incurred in order to make the land ready for use, right? Okay, additional expenditures before the construction began include, you have done some more expenditures before the construction began, included $1,100 attorney fee. Okay, attorney fee, again, it could be for building, it could be for land. Let's figure out for what this attorney fee was paid. So included $1,100 attorney fee for the work concerning the land purchase. So this attorney fee is relevant to the land. $5,000 real estate broker fee. This is relevant to the land. $7,800 architect fee. Okay, before moving on to the architect fee, let's take this real estate broker commission. You are not purchasing building. We are purchasing land. So that's why I'm saying that this amount is going to be the cost of land. Architect fee. We don't do the architect real estate is this 5,000. So this is regarding the land because we purchased the land. Okay, $7,800 architect fee. Architect fee means that you have done some architect work for the building. We don't do architect work for the land. So this is the cost of the building. And $14,000 to put in the driveways and parking lots. We know what is driveways and parking lot. It is land improvement. So we identified each and every cost. So let's figure out what is the requirement of the question. Instruction says that determine the amount to be reported as the cost of land. We only need to calculate the cost of the land in part A. In part B, they says for the cost not used in part A, indicate the account to be debited. So they also want us to tell the names of each and every cost. So let's calculate the cost of the land. Firstly, we have paid $7,500 to purchase the land. We have incurred net cost of raising the warehouse $6,900. And then we did this attorney fee of $1,100. And then real estate broker commission of $5,000. So these are the costs we incur regarding the land, right? So if you see over here, $7,500 cash price, net cost of removing the warehouse, $6,900 attorney fee and real estate broker commission. Altogether, the cost of land is $88,000. Now, two costs which we did not add it before, that is architect fee, this is building, and this $14,000, this is driveways and parking lots. So let's identify architect fee. This one, $7,800 should be debited to building account, and the driveways and parking lot should be debited to land improvement. So this is it about question number 10-3. Let's move on towards another question which I have taken for the depreciation calculation purpose. This is exercise number 10-5. Yellow bus line uses unit of activity method in depreciating its buses. We have talked about three methods of depreciation in this chapter: straight line, unit of activity, and declining balance. Here they say unit of activity method. One bus was purchased on January 1st, 2017. Okay, January 1st, at a cost of 148,000. Over its 4 years useful life, the bus is expected to be driven 100,000 miles. So this is the total mileage this bus can cover. Salvage value is expected to be 8,000. This is the value you are expecting to collect at the end of the life of the bus. So what they want us to do, number one, they want us to calculate or compute the depreciable cost per unit. Per unit means total cost divided by total units, right? So per unit cost, we need to calculate. Even if they don't ask us, we have to calculate it for the unit of activity method, because unit of activity method first step is to calculate the depreciable cost per unit. Okay, let's do this. So what is the total cost? 148,000. How many total units, total miles this bus can drive? 100,000. So if you see here, we have also salvage value of 8,000. So I need to calculate it. I'm going to use this formula: cost minus salvage value divided by 100,000, which is the total units. Why I have deducted this 8,000? Because this 8,000 I will recover at the end of the life. So that's why I have to deduct it, right? If there is no salvage value, I will not deduct anything. So if I minus 8,000 out of 148,000, that will be 140,000 divided by 100,000 miles. So I get what? I get 1.4 per unit, means per mile depreciable cost. So if the bus will drive 1 mile, it will be depreciated 1.4. If it will drive 2 miles, 2 multiplied by 1.4. If it will drive 1,000 miles, 1,000 multiplied by 1 by 4. So this is 1.4. This is how we will be calculating the depreciation. So let's move on towards part B. It says that prepare the depreciation schedule assuming that actual mileage was, so they gave us mileage. In 2017, which is the first year when you purchased the bus drive 26,000 miles. In 2018, it drove 32,000 miles. In 2019, 25,000 miles. And in 2020, 17,000 miles. So let's calculate. They want us prepare a schedule. Look at the terms. If they don't say, then we can just roughly solve it like we solve part A. But they want us to make a table, a schedule. So let's make a schedule. How do we make it? Firstly, first column is years. So we have 4 years, 17, 18, 19, and 20. Second column is how much activity they have performed every year. So if you see here, 26,000 in the first year, 32,000 second year, 25,000 third year, and then 17,000 fourth year, right? So I just wrote all of them over here. So one per unit cost we have calculated, depreciation cost we have calculated, that is 1.4. So if I want to calculate the depreciation cost for 26,000 mile, I have to multiply it with 1.4. So I get annual depreciation expense for 2017, that is 36,400. For the second year, I have to multiply mileage with per unit cost. Third year also, fourth year also. So in this way, I will be getting the annual depreciation expense. Because they want us to calculate make a table, so let's calculate end of the year stuff as well. So accumulated depreciation column and book value we will be writing. What is accumulated depreciation? Accumulated depreciation add up every year depreciation in it, right? Because it's accumulate the depreciation expense. So first year we do not have any opening accumulated depreciation, so the annual depreciation or the first year depreciation will be put into the basket of accumulated depreciation. Consider accumulated depreciation that it's a basket, okay? So first year depreciation comes here, which is 36,400. Then then second year we have charged the depreciation of 44,800. So this 44,800 will also be added. So now accumulated depreciation has a total balance of 81,200. So this is what I write over here. Then the third year, 35,000 is added. So 35,000. Already how much balance was there? 81,200. So now it's increased with 35,000. So now total balance is 16,200. And then fourth year depreciation will also be added. So ultimately accumulated depreciation will have a balance of 140,000. Book value. What is the formula of book value? Cost minus accumulated depreciation, right? Cost was how much? 148,000. Accumulated depreciation for first year is 36,400. So minus 36,400. So I get my first year book value. Second year book value, cost is still 148,000, but accumulated depreciation is now 81,200. So my book value becomes 66,800. Third year again, cost is 148,000. Accumulated depreciation is 116,200. So I get my book value 31,800. While in fourth year, cost is again 148,000. Accumulated depreciation is 140,000. So I get my book value of 8,000. So this is how we prepare the schedule for the depreciation in case of unit of activity method. Let's move towards our next question, which is question number 10-7. Let's read it and try to solve it. Linton Company purchased a delivery truck for $34,000 on January 1st, 2017. The truck has an expected salvage value of $2,000. Remember, residual value, salvage value, they all are the same thing, and is expected to be driven 100,000 miles over its estimated useful life of 8 years. So the total mileage, total activity it can perform, that is 100,000. Total life in years is 8 years. Actual mile driven were 15,000 in 2017 and 12,000 in 2018. They did not tell us the mileage for all the 8 years. They only told us for the first 2 years. Let's read the requirements. Number 1. Compute depreciation expense for 2017 and 2018 using straight line method, the first method, unit of activity method, the second method, and the double declining balance method. I will come to point number B once I'll be done with point number 1. Okay, so let's do point number 1, starting with straight line method. The formula for straight line method is cost minus salvage value divided by life in years. And this life is useful life. Okay, so cost is 34,000. Salvage value is 2,000. So the numerator becomes 32,000. This is known as depreciable cost. So in other words, you can say depreciable cost divided by life in years is the formula for straight line method. So I got depreciable cost 32,000, life in years is 8, so 4,000 is going to be annual depreciation. Straight line depreciation is known as straight line because on the graph its depreciation remains straight, means every year the depreciation is the same, right? So 4,000 for the first year, 4,000 for the second year, every year it's going to be the same. You can also calculate this depreciation by using the depreciation rate. Right? So what is the straight line rate? The formula to calculate the straight line rate is 100% divided by life in years. So 100% divided by 8, that gives me the straight line rate of 12.5%. So every year asset will depreciate with 12.5%. Okay, so how I'm going to do that? Again, depreciable cost, this one, depreciable cost multiplied by the rate. So depreciable cost for me is 32,000. Rate, I calculated it's 12.5%, so 4,000 every year. So depreciation for 2017 is 4,000, depreciation for 2018 is 4,000 under straight line method. Let's move towards the second method, which is unit of activity method. And don't forget that unit of activity method needs activity every year as well. So for 2 years, 2017 and 18, they want us. So 15,000 miles were used in 2017 and 12,000 miles were used in 2018. So let's do this. Uh, Firstly, let's calculate per unit depreciation expense. So how we are going to do that? Depreciable cost divided by miles, okay? Total miles it can cover. So depreciable cost we calculated even in part 1 as well. So that was 32,000 divided by how much miles it can drive overall in its life. That is, they gave us 100,000, okay? So let's do this. 100,000, when I divide it with 100,000, per mile depreciation expense becomes 0.32. So let's calculate for 2017 and 2018. So 2017, 15,000 mile the truck drive, so 0.32. So 4,800 is the depreciation expense for 2017. And in 2018, 12,000 miles it drove, 0.32 is per mile. So total depreciation expense for 2018 is 33,840. Lastly, third method which they want us to use, that is double declining balance method. Double declining balance method is known as double because it doubles the rate of straight line. And it uses it. So just few minutes back, we calculated the straight line rate of 12.5%. Double it, multiplied by 2. So 25% is the rate we will be using for double declining balance method. Okay. So see here, we also calculate it over here. Let's calculate depreciation expense. Remember, when I taught you the theoretical topic of double declining balance method, I told you that this method does not use depreciable cost. It uses cost only. Okay. So, and then initially it uses the cost, or in other words, for the simple way, you can say this is the method which uses the book value. Always opening book value for the calculation of depreciation. So in the first year, which is 2017, the opening book value, what is the formula for book value? We just took it cost minus accumulated depreciation. In the first year, we do not have any accumulated depreciation, but we have a cost of 34,000. So book value was 34,000. So I wrote it here, 34,000 multiplied by rate, which is 25%. So depreciation expense for first year is 8,500. For the second year, we have to calculate the book value. So cost, what is the cost? Cost is 34,000. Accumulated depreciation, first year depreciation is already there. That is 8,500. So my second year, you can say book value becomes 25,000. Okay. I also mentioned it here with the static. 25,000 multiplied by 25%, so 6,375 is the depreciation expense for 2018. Let's read point B so that we can solve it. Point B says that assume Linton uses straight line method. In part A, we uses all the three methods, but now for the point B, they say that a company uses only straight line method. Prepare the journal entry to record 2017 depreciation, only 2017. Show how the truck would be reported in December 31st, 2017 balance sheet. So they want us to record the journal entry and then show the balance sheet presentation. So let's record the journal entry. Depreciation expense gets debit, accumulated depreciation gets credit. In straight line method, which was over here, we calculated annual depreciation of 4,000, which was for 2017 and 2018 as well. So the journal entry will be debited with here depreciation expense gets debit 4,000 and accumulated depreciation equipment gets credit 4,000. How the balance sheet presentation looks like? In balance sheet, under the assets, non-current asset, equipment will be mentioned first with its cost, less accumulated depreciation, and then book value. Sometimes you will find book value, sometimes nothing will be written here, but the book value is cost minus accumulated depreciation, so 30,000. So this is it for your question number 7. Okay, let's move on towards exercise number 10-9. Presented below are selected transaction of rich company for 2017. January 1st, retired a piece of machinery that was purchased on January 1st, 2007. When you are retiring, 2017. What's the date? January 1st. And actually, you have purchased 10 years back on January 1st, 2007. The machine cost $62,000 on that date. Which date? When you have purchased it. Okay, at that time it cost $62,000. It had a useful life of 10 years with no salvage value. It means that we have fully depreciated the equipment. How would I know? Because the life was 10 years. We purchased it on January 1st, 2007 and we are retiring it on January 1st, 2017. So from 2007 January 1st till December January 1st 2017, 10 years are over. So accumulated depreciation is being charged for all the 10 years, and the balance we expect is 62,000 in this account. Okay, so let's record this journal entry. uh, January 1st, accumulated depreciation gets debit, equipment gets credit, 62,000 and 62,000. Let me just quickly read the requirements with you, because it's not that simple as we can see over here. Because we have to update the depreciation account every time we want to sell or we want to retire an asset. So here, let's read the full question and then we will be recording the journal entries for the remaining dates. So June 30th, sold a computer that was purchased on January 1st, 2014. The computer cost $45,000. It had a useful life of 5 years with no salvage value. The computer was sold for $14. Okay, so this is about the sale of computer. That's an equipment. December 31st, discarded a delivery truck that was purchased on January 1st, 2013. The truck cost $33,000. It was depreciated based on 6 years useful life with 3,000 salvage value. Okay, so two more dates are there. What we are supposed to do, we are supposed to journalize all the entries required on the above dates. First entry I already discussed with you, and this is all the entries. These entries include updating the depreciation where applicable on asset disposed of. Okay, and this company uses straight line depreciation method. One more information is assume depreciation is up to date as of December 31st, 2016. So till last year, all the depreciation is being recorded. So let's start with the entry number 2, which is on June 30th. Let's read it again. Sold a computer that was purchased on January 1st, 2014. So we are selling a computer which was purchased in 2014. We kept it for 2014, we used it for 2015, we used it on 2016, and in 2017, June 30th, we are selling it. So it means that 6 months of 2017, this computer was with us, right? So we have to update the depreciation. They said till 2016, all the depreciation is already being recorded. So we are worried about 2017, 6 months depreciation. In order to calculate 6 months depreciation, we should know the annual depreciation. And this company uses straight line method, and it does not have, for this truck, it has, let's quickly see, no salvage value. Okay, so what's the formula for straight line depreciation? I'll be using this space. Okay, the straight line depreciation formula is cost minus salvage value divided by useful life in years, right? So cost for this truck is, this computer is $45,000, and the useful life in years for this computer is 5 years. So annual depreciation comes up 9,000, right? Okay, now this 9,000 we have recorded already in 2014. We also recorded it in 2015, also in 2016, but in 2017 we have to record it, right? But only for 6 months. So 9,000 is full year. Let's add partial year, which is 6 by 12. So we get 4,500. So let's record this and then record the entry for the state. Okay. So here I'm recording this depreciation expense gets debit, accumulated depreciation gets credit. I wrote the formula over here. So 4,500 and 4,500. In order to record the sale, I want to see, do I have a gain or loss or nothing by selling this computer? So how would I know? The way is to compare the sale value with the book value. If the sale value is greater than the book value, you have a gain. Okay. If the sale value is less than the book value, you have a loss. Right? So let's check out for this computer. I need to calculate the book value for this comparison because sale price I know it's 14,000, right? So book value is cost minus accumulated depreciation, right? Cost for this computer is 45,000. Accumulated depreciation, we have already recorded that means I did for year wise over here that 9,000 plus 9,000, 18,000 plus 9,000, 27,000 plus 4,500, 31,500 is accumulated depreciation, right? So 31,500 it's going to be accumulated depreciation, and I will get my book value. So I sold this equipment for how much? 14,000, and I'm selling it for I purchased this equipment for 45,000. I have calculated the book value, and now I'm going to compare the book value with the sale price. So 14,000 will be compared. So I did this calculation over here. 14,000 minus this the difference between the calculation of book value. So I got a gain of 500. How do I know that gain is 500? Because this amount is 13,500. Okay, so basically the asset book value was 13,500, which is less than the sale price, which is 14,000. So we have a gain on sale of 500. So let's record this transaction. By selling this computer, we get cash of 14,000. We will sell this computer, so equipment will get credit with its cost, and because we are crediting the equipment, we have to debit accumulated depreciation, which we just calculated 31,500, and we also calculated the gain on the sale of this equipment. So gains are credited like profits. So gain on disposal of plant asset, that is 500. This is it for journal entry number 2. Let's do the journal entry number 3, which is on December 31st, 2017. Let's read it out and try to solve it. Company has discarded, they didn't sell, they discarded a delivery truck that was purchased on January 1st, 2013. So the truck has a cost of 33,000. It was depreciated based on 6 years useful life with 3,000 salvage value. We are in 2017 and we saw this journal entry, but we have to update the depreciation first for all the 12 months because we are selling it on the last day of the year, right? So if this is the case, so let's calculate its depreciation. Straight line depreciation cost is 33,000, salvage value is 3,000, useful life is 6 year, so 5,000 every year we are going to have depreciation. So let's record this depreciation first. Depreciation expense gets debit, accumulated depreciation gets credit, 5,000 and 5,000. Let's check, do we have a gain or loss? This is a discarding. So we don't know that we have fully used this truck or not. So let's check out what is accumulated depreciation. So if you see over here, let's count the year. It was purchased on 2013 and we are standing on 2017. So 2013, 14, 15, 16 and 17. 5 years, right? Every year depreciation we have calculated 5,000. 5 years we use this truck 25,000. So the cost for this truck was 33,000. We are discarding it, we are not even getting the salvage value, right? So it means that this was what we expect that we will be getting by using this truck, but we only utilize it for 25,000. So rest is what? That's a loss for us because we are discarding it, we are not even selling it, right? So let's record the loss on disposal of the plant assets. That's 8,000. Accumulated depreciation will remove because the equipment is going to be sold, 25,000, and equipment will be credited with 33,000. Let's move on towards the next question, which is exercise number 10-10. Price company owns an equipment that cost $65,000 when purchased on January 1st, 2014. It has been depreciated using straight line method based on estimated salvage value of 5,000 and a useful life of 5 years. They want us to record the journal entries by keeping these four assumptions in our mind. Prepare pricey companies' journal entries to record the sale of the equipment in four of the independent situations. Don't confuse them with each other. Think when you are doing part A, that's the only thing you are doing. When you are doing part A, part B, you did not do part A. It's an independent transaction you will be recording. So these are four assumptions, okay, four choices for us. Sold for 31,000 on January 1st, 2017. Okay, let's figure out. We have purchased it in 2014, 2015 also we used it, 2016, and January 1st, 2017, so we didn't use it for 2017, okay, because it's January 1st. Cost is 65,000, salvage value is 5,000, and the useful life is 5 years. Let's check out what is the accumulated depreciation. So for that purpose, I need depreciation. So cost 65,000 minus salvage value, which is 5,000, divided by useful life, which is 5 years. So let's calculate this. That will be 60,000 divided by 5, so 12,000 every year. Okay. Now let's move on towards checking, do we have a gain or loss? So 12,000 second year and also 12,000 third year. You can also multiply it with 3. So that will be 36,000 accumulated depreciation. Okay, so let's check, do we have a gain or do we have a loss? We are selling it for 31,000. Let's check sale and book value comparison. So sale price is 31,000. What is the book value? Cost minus accumulated depreciation. So cost is 65,000. Accumulated depreciation is 36,000. So we have actually a gain of 2,000. Why? Because we book value is 29,000. So sale is bigger. We are selling it at a profit of 2,000, right? Fine. Let's record the journal entry. We got the cash because we sold it for 31,000. We are removing equipment, so its accumulated depreciation will also be removed. I showed you how did I calculate it. Equipment will be removed with its cost, and we have a gain of 2,000. Let's check the second journal entry. Sold for 31,000 on May 1st, not January 1st. Okay. Depreciation calculation is exactly the same, but now some months of 2017 are also added. How many months? 4 months. Why? Because May 1st. So January, February, March, and April, 4 months. So I need to calculate partial year depreciation, 12,000 multiplied by 4 months out of 12 months. So here I get 4,000. So it's no more 36,000, it's plus 4,000, that is 40,000 is the accumulated depreciation. Okay, 40,000, so 65,000 minus 40,000. Let me write it clearly. Okay, I need to calculate the updated book value. 65,000 is cost, 40,000 is accumulated depreciation now. So this is no more 29, this is going to be 25,000. Now I have I need to firstly record the journal entry. This amount is also different. This is no more 31,000 is 6,000 more than book value. up again. Let's record both journal entries. Firstly, update the depreciation for 4 months. So depreciation expense gets debit, accumulated depreciation gets credit, 4,000 and 4,000. I just showed you that how did I calculate it. If you see over here, this one. Okay. So in the same way we did over here. This is part B. So let's check it out. Okay. So I have recorded depreciation expense gets debit 4,000, accumulated depreciation credit 4,000. I put a static over here. So here is the calculation for this. Okay, then record the sale. Cash gets debit 31,000. We remove the equipment from our books. Equipment gets credit with its cost and accumulated depreciation. I showed you that how did we calculate. I mentioned it over here that 3 years is 36,000 plus 4,000 of current years, altogether 40,000. Okay, so 40,000 accumulated depreciation, and we have a gain of 6,000. Let's move on towards point number C, which is sold on January 1st, 2017 for 11,000. So let's use the data which we had before. So no more 2017. We are selling it on January 1st, 2017. So accumulated depreciation is 36,000. Okay, and here I need to change it to book value. Book value is how much? Cost 65,000 minus 36,000. So that's get 29,000. But now my sale price is 11,000. Right, students? So now the book value is more. I'm selling it at a lesser price. Lesser how much? Lesser 18,000. So now I have a loss. Right? So let's record this journal entry. Cash gets debit. I got the cash of 11,000. Accumulated depreciation 36,000 will be removed. Loss will be recorded and equipment will be removed from the books. Let's move on towards the fourth question, that fourth part, that is we sell it for 11,000 on October 1st. Now we have to update the depreciation that we also use this equipment in 2017. 12,000 is the annual depreciation. October is the 10th month, October 1st. It means that October will not be included. So I have to add 9,000 into it, right? Because 12,000 multiplied by 9 by 12 is 9,000. So 36,000 for the last 3 years plus 9,000. So my book value is, sorry, my accumulated depreciation is 45,000. I need to calculate my book value. So my book value is 20,000. So now if you see here, sale price is 11, which is less than 20,000. Book value is more. So now we have again a loss of how much? A loss of 9,000. Let's record both journal entries, updating the depreciation and then recording the sale value. So I'm updated the depreciation. Depreciation expense gets debit. Accumulated depreciation gets credit. 9,000 and 9,000. I get the cash of 11,000. Accumulated depreciation gets debit. 45,000. We just calculated up, and then we recorded a loss of 9,000, and equipment is removed from our books. So this is it about this question, which is question number 10. Let's move on towards question number 11. On July 1st, 2017, Friedman Incorporation invested $720,000 in a mine. Okay, mines are natural resources, right? Estimated to have 900,000 tons of ore of uniform grade, means all the ore is of uniform quality. During the last 6 months of 2017, why they are saying last 6 months? Because we invested on July 1st, 2017. So from July till December, they are 6 months. Okay, so during the last 6 months of 2017, 100,000 tons of ore were mined, means you extracted 100,000 tons. And when you extract, they goes to your inventory, right? Remember that? For the natural resources we use, yes, unit of activity method. So we need to calculate per unit what is the concept we use for natural resources? Depletion, right? So let's record it, but let's read the full question first. Part A says that prepare the journal entry to record the depletion. So we have to record the depletion. Let's record it, then we will read part B. Okay, so whatever we extract, that goes to our inventory because we have to sell it, right? But before that, let's calculate per unit depletion. So I did over here. So let's see. Cost is $720,000. Total activity, total units this mine has is 900,000 tons. So I denote cost with A and tons with B, and we know that A by B is our depletion cost per unit, right? So A divided by B, 720,000 divided by 900,000, I get $0.8 per unit depletion. So as many units I will extract, I'll multiply it with 0.8. Okay. So how many units I have extracted? 100,000 units. The extracted per unit is 0.8. So in this way, total depletion, accumulated depletion is 80,000. I will not debit here depletion expense. Basically, inventory is the term we use. Why? Because firstly, we extract the natural resource that becomes our inventory. Then we sell this inventory and we transfer the inventory cost to the cost of goods sold. In this way, it goes to our income statement, not in form of depreciation or depletion expense. Okay, so inventory gets debit 80,000 and accumulated depreciation gets credit 80,000. Point number B says that assume that the 100,000 tons of ore were mined. Yes, we said 100,000 ores were mined, but only 80,000 were sold. So how are the costs applicable to 20,000 unsold units? See here how many units you have mined, means you extracted 1,000 units. Out of these, 80,000 units were sold. This is in our inventory, right? Because we extracted and we put these units in our inventory, and the cost was $80,000. See here, this one. Okay, out of these 100,000 units, we sold 80,000 units. So they go where? They go to cost of goods sold account. I need dollar amount. 80,000 multiplied by 0.8, so that is 64,000. Okay, they say what is the cost of remaining unsold units and where it will be. So it will of course stay in inventory account. And what is the cost? 20,000 units multiplied by 0.8, so the cost is $16,000. It will stay in inventory account until and unless we sell it. So this is what I wrote here. Remaining 20,000 unsold units will remain in inventory and their cost would be $16,000. Okay. Let's move on towards exercise number 10-12. The following are selected 2017 transaction for Pettico Corporation. January 1st purchased a small company. They purchased a business and recorded goodwill of $150,000. Regarding goodwill, we are very clear that we can record the goodwill in our books when we purchase an entire business. So yes, here this Pettico company is purchasing an entire company. Its useful life is indefinite. We also know that goodwill is not, amortized, but yes, we value it. We do the evaluation for this, but in this chapter, we did not took this concept. But yes, we talked about amortization, and goodwill is not amortized. Then May 1st, what happened? Purchased $75,000, a patent with an estimated useful life of 5 years and a legal life of 20 years. Remember, for patents, we compared legal life with the useful life. Whichever is shorter, we take that. So here, the shorter is useful life, so 5 years will be taken. And yes, for patent, if they have limited life, we calculate amortization on them, right? They say prepare the necessary adjusting entry at December 31st to record the amortization required by the above events. Don't get confused. Be very clear about goodwill that it is not amortized. Okay, it is only valued, so no need, no amortization for the goodwill. But yes, for patent we can do that. The full annual amortization, first let's calculate that. 75,000 divided by 5, right? But we need partial. Why partial? Because we purchased it on May 1st. So from May 1st till December 31st, it stayed with us. So how many months? 8 by 12. So in this way, I get an answer of 10,000. So amortization expense gets debit, patent gets credit, 10,000 and 10,000. Let's take our last question, that is exercise number 10-13. Guild Company organized in 2017 has the following transactions related to intangible assets. Related to intangible. They didn't say all of them are intangible, but yes, these transactions are related to intangible. We will read them, but let's read the instructions. Prepare the necessary entries to record these intangibles. So firstly, we need to record them. All costs incurred were for cash. Just to make our concept clear and recording easy, they say that all of them are done in cash basis. Make the adjusting entries as of December 31st, 2017, recording any necessary amortization and reflecting all the balance accurately on that day. So here they want us to do two things. Firstly, they want us to record the amortization, and also they want us to tell the ending balances on December 31st for all these transactions. Okay, so let's check. 1 to 17. It means 1 is month, 2 is date. So 2nd January 2017. They purchased patent. 7 years is the life. The cost for the patent is 595,000. So let's record it. You get an intangible, right? So patent gets debit and cash gets credit, 595,000. Second. 4/1 2017, April 1st 2017, goodwill purchased, indefinite life, 360,000. So you purchase a goodwill. How did you purchase? We know that they might have acquired a business. So 360,000. So goodwill gets debit, cash gets credit, 360,000. 7/1/2017, July 1st, 2017, 10 years franchise. Expiration date is July 1st, 2027. Okay. What is the cost for this franchise? They have incurred a cost of 480,000. So let's record it. Franchise gets debit, cash gets credit, 480,000. Let's check the last one. 9/1/2017. 9 means September 1st, 2017. Research and development cost 185,000. What did I tell you about research and development? We do a lot of research and development to invent new, to do inventions. And for those inventions, we get the patents, right? And we are already very clear about patents, that patent includes the cost of just registering those patents, with defending or registering those patents, right? All the R&D cost, which is research and development cost, is expensed. We do not add it to the cost of patent. So this R&D is expense for us. So expense gets debit and cash gets credit. So if you see here, research and development expense gets debit, cash gets credit, 185, 185. Now we need to calculate part B, which says that amortization. Don't forget to check the dates, okay? Let's first figure out which intangible assets are eligible for amortization. Okay, so we have 3 intangible assets. Research and developments are not intangible, right? They are expenses. And amortization are for intangible. Patent, yes, we need to calculate its amortization. Goodwill, no need because it's indefinite. Franchise, yes, 10 years is the life. Patent life is 7 years, right? For amortization, when I was discussing the theory content, I told you we use straight line method for amortization, right? Which is cost minus salvage value divided by useful life in years. We don't have salvage value, we have only cost. But don't forget the partial year, okay? Partial here, this one. For franchise, it's partial. It's on July 1st, so 6 months only, okay? So let's do this. We will be calculating the amortization for 2 things. Amortization expense gets debit, and my both assets, intangible, patent and franchise, will get credit. For patent, I will be calculating the amortization. 595,000 divided by 7, so that is 85,000. For franchise, what is the cost? The cost is 480,000. Okay, for a franchise, it's my pen. Yeah. 480,000. The life is 10 years, but I have partial year, 6 by 12. So 24,000 is my and this 6 months franchise amortization. So franchise will get credit with this, and by adding these two, I get my amortization expense 109,000. In part B, they also want us to tell the ending balances. So patent will be 510,000. Why? Because cost minus the amortization, which we already did. Patent has been reduced because of 85. Goodwill stays the same. Franchise is 456,000. 480,000 is the cost. 24,000 we have reduced it because of amortization. So remaining is 456,000. Research and development expenses. Expenses are temporary accounts. So all the temporary accounts are closed, right? So basically its balance will be closed. There will be nothing because at the start of every year the balance is zero, but because they are asking end of the year, so you can write 185,000. You can also write zero because ultimately it will turn to zero. Why? Because it will be closed to retain earnings later on. So this is it about the discussion of questions regarding chapter number 10. I hope these questions are very clear to you. If you have any questions or something is not clear to you, you can write in the comment section. And soon I will be uploading the recording of chapter number 11 exercises, which is about current liabilities. If something is not clear, please do write on the comment section, and like and subscribe the channel. By subscribing, it's helpful for you because wherever new videos I will be uploading, you will get a notification for that. If you don't subscribe, then in that case you have to come back to the channel again and again and check that new videos are there or not. Okay, take care everyone. See you with the next video soon. Take care. Bye.